Hello, folks, and welcome to another episode of Advisor Insider. I'm Jeff Benjamin, your host with ETF.com. This is our last Advisor Insider podcast of the year, and we got a good one for you. We have our guest is Stuart Chaussee of Stuart Chaussee and Associates in Beverly Hills, California. He's a registered investment advisor, and he's written a few books. But his latest one, I think it's his latest one, he'll tell us all about it, is Investor's Guide to Buffer ETFs. Buffer ETFs is one of the hottest topics of the year. And I'm going to tell you, everything is there that you would need if you're an advisor or an investor to follow along and learn about buffer ETFs. And in the show notes of this episode, we're going to have a link to a PDF where you can get the whole book for free. So bonus. Stuart, how you doing? Thanks for being here.
I'm doing great. Thank you, Jeff. Thanks for having me.
Yeah. Is this your most recent book?
Oh, yes, indeed. That was written earlier this year.
Okay, what got you on this topic?
Well, I've been tracking the defined outcome space for about 4 years. Finally started investing for my clients a couple of years ago, but there was really just a lack of, I think, educational material online. I don't think even one book before mine was written on the subject, and with it's attracting billions of dollars, and I thought it was time to at least get something out there to educate the public and advisors.
Yeah, I know a lot of the ETF issuers that have these buffer products have educational programs, and I'm not saying that they're not any good. I think a lot of them are good, but it's nice to see something coming from a less interested party. You don't have
There you go.
You're not you're not pushing any products of your own.
No.
Let's start with what these things are for the less informed on this topic. Why don't you kind of give us the ABCs of buffer ETFs?
All right. Well, a buffer ETF, I think, in its simplest form, is basically an investment that gives the purchaser a defined outcome, or an outcome that is known before you invest. And that outcome entails a level of downside protection and also what's called an upside cap, which means that your performance is also capped out on the upside. And that's over a defined outcome period, which is typically 12 months, although they have buffer ETFs with 3-month outcome periods, 6 months, 12 months, and actually even 2 years now.
Right. And to get the full benefit, to be clear, you have to hold them the full maturity, right?
You do.
Okay.
There are strategies, intra-outcome, which it's called, to make trades during that outcome period, but to get the full, what we'd call the published parameters or outcome parameters on the reset date, is you'd want to hold it for the full period. That's right.
And I want to make one point of clarification, is that the outcome isn't necessarily defined. The parameters are defined, right? If you have a buffer that has let's say a 10% downside loss limit on the S&P 500 and a 15% upside cap, that doesn't mean you're going to get 15%, and it doesn't mean you're going to go down. The S&P could do 5% that year, and that's what you get is the 5% less fees, correct?
That's correct. Yeah, the outcome is defined within those two parameters, that downside, so the downside protection and the upside cap. But sure, let's say you have 10% protection, the S&P, you're tracking SPY, and SPY declines 20, you had 10% protection, you'd be down around 10. And on the upside, let's say you have the caps, let's just call it 15% over 12 months. If it goes up, SPY goes up 20, you'll make that 15. You'd give up 5%.
Right. Let's talk market sizing. In your book here, it says in 2018, there was 200 million in total assets. I don't know how many ETFs there were in this category. When you published this book in 2024, it was at 35 billion. Our data at ETF.com shows 211 buffer ETFs and more than 45 billion. So it's obviously a fast growing category, right? I mean, this is everywhere.
It may well be the fastest growing ETF category.
Okay, what's driving the growth?
I think a lot of the growth is, driven by a couple factors. I think a lot of advisors and investors are well aware that stocks are pricey, expensive by many, whatever ratio you choose, price to book, PEs, whatever you want to keep, whatever you look at, they're not cheap at all. So, and I think the volatility of the market, when you look back at 22 and how stocks and bonds both got creamed that year, and then you've had a nice surge recovery here the last couple of years. But I think that volatility has also made the appeal, of having some level of protection in place, sort of just in case. I think that has also helped these ETFs surge in popularity also.
Right. How are they used generally by investors and more importantly, financial advisors?
I think, okay. I think most advisors will use them as a sleeve, a percentage of an overall allocation for a client. So, let's say they traditionally have, let's just say 60-40, and they don't really like the bond market, for example, or yields are not attractive enough on the 40% side. So they may well scale back the bond allocation. Let's just say they cut it in half, and they might allocate then 20% to buffer ETFs and keep 20% in bonds. So, that I think is probably the most popular strategy. Some advisors like myself, I now have the core of my assets in buffer ETFs. So I really don't have that fixed income sleeve anymore. And so I'm pretty much all buffers.
Do you see buffers as a replacement for fixed income?
I think they can be. Yeah, I think the upside's a lot more attractive. If you're looking at what corporate bonds are paying, even investment grade, whether you're looking at treasuries, et cetera, if you think the stock market will return on average more than what those corporates are paying, but you want to have some level of protection, I think this is a really good way to do it, because if the market's good over the coming decade or however long, you got a shot to double or triple those returns on fixed income.
So, what kind of investors do you think are using these or are best suited for buffers? Are they people in or near retirement? Are they people who are nervous about the volatility in the markets? I mean, I wouldn't think it would be somebody that's a younger person with a 40 or 50 years ahead of them, right? Or no?
I know, I agree with what you said there. I think it's typically pre-retirees or retirees who still want to have exposure to stocks, the upside, again, even though it's capped, but they want to have some level of protection, right? If they're retired, they can't make their money back through work, salary, et cetera. So they can't sit through, let's say a 30% decline in the market. So they want some protection, but they'd like to be able to still own stocks and participate in that upside growth. So it allows them to do so. And so, I think they typically appeal to conservative, moderate risk investors, regardless of age. You could have a younger, somebody in 30s or 40s who's kind of more defensive minded and does not want to see a deep decline in a portfolio. So they may well own some buffers too.
Okay. Our data shows the average expense ratio of these buffer ETFs at 78 basis points. Are you paying too much for essentially index performance? Because that 78 basis points, that's the insurance that you're paying for. But, I'm asking the question that way.
Well, no, it's a good question. It shouldn't be ignored. The fees should not be ignored. But, I looked into that. You really cannot do this on your own, or you can't do this on your own in a tax efficient way. And if you were to do, these are option strategies within an ETF wrapper, and they're typically 4 option contracts within the wrapper. But if you were to do those yourself, the upside cap, what I've looked at and talked about with some of the firms that do the strategies, it could cost you 2-3% of the cap. So say if one of the big providers an Innovator or First Trust were to do it, you would get an upside cap that's probably 2 or 3% less than they could get for you in these products. So because you can't really do it yourself, maybe you could say, well, that fee is justified. Now, sure, we'd like to see fees come down. I mean, iShares has some that are 50 basis points, and Prudential also is around 50 basis points. Okay. So maybe, I don't know if the trend's coming down on the fees, but I think the bottom line, Jeff, is that if you're satisfied with the upside cap, the net cap for you after those fees, that's what's most important.
Yeah, there you go. All right, let's talk about some advantages and disadvantages. We'll start with the advantages. We might have talked about most of those already, but I'm still going to give you a chance to hit the high notes.
Yeah, I think the primary advantage is you're invested with some protection. So it can really give you peace of mind. I think it's a much smoother ride. The beta on these buffers is around 0.5. So, if the market's up 1%, maybe you're up 0.5. And same on the downside, at least at the start of the outcome period. But as you near the end of the outcome period, you may well track the index 1-to-1 or closely, but you'll still get those published outcome parameters, right? That you were aware of on the reset date when you bought in. So it's just a smoother ride. I think that's an advantage. The investor knows that he or she has a certain level of protection. And if the market's good, you'll generally capture most of that return. And if the market's bad, let's say you have 15% protection, all right, you're going to roughly break even, which is that's a real win in a bad market like 22. I think that's the primary advantage there, is just allowing you to stay invested with some peace of mind, protection in place, and still a decent potential return on your money also.
Okay, what about some disadvantages?
I think the disadvantages are at the extremes. So you could use this year as an extreme, right? I think few predicted the NASDAQ and the S&P 500 would be up as much as they're up. So if you bought a buffer ETF, let's say December 31st of 23, which was the reset date for a January series for 24, and you were to hold it for 12 months, which is coming up here in about a week, you would have been capped out. Let's say you were capped out at 14 or 15%, for example. Well, you missed out, right? You missed out on a good 10% or so.
Right.
That's definitely a disadvantage in a year when the index soars, or whatever your underlying asset is, the NASDAQ 100 or S&P 500 or small caps, whatever. You're going to underperform. And on the flip side, if you get into a crash or a deep bear market and you've got 15% protection, that probably won't be enough, right? It may well decline 20 or more, so that you could lose money,
right?
If you have an extremely bad market.
Well, but still, your downside limit is your downside limit, no matter what the market does. Right.
You're protected on the initial 15% decline.
Oh, I'm sorry. That's right. That's right. You're protected on the initial 15%. Beyond that, you're on your own.
But that would have to be Jeff. That would have to be a 15% decline during that outcome period, and then when it resets again, you get another 15%.
Right.
So if the market were down 30 over 2 years, 15 in each year, you may well have just broken even. It just depends on how it declines. And over what
about now? We talked about you have to buy these at the issuance date to get the full benefits, but you can buy them throughout the year and sell them throughout the year, right? They're liquid. They're ETFs.
They're extremely liquid. They're tax efficient because on those roll dates, the reset dates, they don't distribute any capital gains like traditional mutual funds. So they're tax efficient like traditional ETFs. You can buy them intra-outcome, and I think that's a great advantage. And on at least on First Trust, on all the primary issuers, their websites, whether you're looking at Allianz, First Trust, or Innovator,
Uh-huh.
They show you the parameters of all their buffers on any given day. And so you will know what the upside is and what the downside is.
Right.
So you can indeed purchase them intra outcome. You just have to be careful, because if the underlying asset has moved up and the buffer's moved up, let's just say let's just say SPY moved up 10%, you were up 5 in the buffer. If you go and buy it at that point, well, you're not going to be protected until back down to 0. So if the S&P turns around and declines, you could lose 5% before you get your protection.
So if there's an extreme market volatility before you buy in a year or in a period, you should probably wait, right?
Yeah, if you've had an extreme period, I mean, and the market's down quite a bit, the intra-outcome parameters could be pretty darn interesting, because you might be able, let's say, you might be able to buy a buffer that, say, reset 6 months ago, but it has parameters now, say 6 months later, that are very similar to what they were at the outset of the outcome period. So you, in effect, you have an upside cap. Let's just say just hear me out here. Let's just say there was a upside cap of 15 when the buffer was first reset. 6 months later, the market crashed. The buffer held up relatively well, let's say, but you could buy in and maybe have a lot more upside on an annualized basis, because you might have that same cap and upside potential, but over a 6-month period as opposed to 12.
Okay.
Yeah. So there you can, I would encourage your listeners to check the issuer's website and take a look at those parameters. So their parameters will tell you, okay, if the underlying asset is up 5%, I would make 3% or 4%. If it's up 10, I'd make 9, et cetera. And same on the downside. So you know exactly what they are when you're buying in.
Okay, that makes sense. Well, 100% downside protection. That's the newest iteration of this, these buffers. What do you think of those? How do they work? You mean you just can't lose your money? Your principal?
That's right. You got 100% protection, typically over a 12-month period, although there are some at 6 months and some at 2 years. Personally, I think it's a little bit overkill. Who needs 100% protection? If that market were to go down that much, we've got other problems. But the upside caps are still not bad on those, and the reason is, to purchase protection for an issuer, to purchase protection, say, from a decline of, say, 20% down to minus 100, it's inexpensive. So, in other words, you're not giving up that much more upside than you would be with a 20% buffer. So you could say, well, why not just protect the whole thing? So I understand that, and it would appeal to somebody, who's super conservative. But personally, I'd rather have a little higher upside. So I have typically not purchased buffers with more protection than 15%. That's kind of been I don't want to call it a limit, but that's about where I think the sweet spot is.
All right. And what do you see as coming around the next bend for buffer ETFs? How creative can the issuers get?
I'll be curious to see if we start to see these products pop up as sector buffers.
Oh yeah.
Why not be able to track the different, all the different sectors of the S&P or the Russell 2000 or mid caps? Yeah, you've got them now on basically SPY, IWM, the Russell 2000, QQQ, NASDAQ 100, and then you have EFA and emerging markets with EEM. But I could see it expanding out into sectors, and there's also, I should mention, you also have some attention being paid now to what are called buffer income ETFs. And it's kind of fascinating. So let's just say we get in a period where stocks are really not doing well, or they're just basically in a sideways trend. You can own buffer ETFs that pay monthly income. Right now, that's typically between 5.5% to 6.5% annualized. And they track the S&P 500, but they give you a level of protection on the downside. So that might be attractive too for clients who are, or investors looking for income from their investments. So you don't have your upside cap, so to speak, is just the level of income that you're going to receive, and you'll receive the income even if the S&P does poorly, but you have the protection. You have the protection down, say, to minus 10% or minus 15%. Beyond that, you would lose money, but the level of income is quite a bit higher than, say, Treasury bills are paying. That may well be something interesting in the future, I think.
All right, we will keep an eye on it. It's a fun category, and we'll be in touch with you, Stuart, on the latest developments, because it seems like you've got a pretty good handle on this stuff. I want to thank Stuart Chaussee, financial advisor with his own firm, Stuart Chaussee and Associates in Beverly Hills. And we're talking about his latest book, Investor's Guide to Buffer ETFs. And as I mentioned earlier, we're going to put a link to the PDF of the book in the show notes, and you can get that for free. What's better than that, right? I want to remind our audience to our awards, our ETF awards. Nominations are still open until January 10th. So get those in if you got an ETF or if you want to nominate an ETF. But until then, I guess we'll talk to you in 2025. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. Thank you very much, folks.